Short selling is a risky business, even very risky business. So before you dive in, you should make sure you know all the risks and fully aware to the possible consequences of short selling. 1. Your stock value may increase. If you've already shorted a stock, what will happen when its value suddenly goes up? You may feel like kicking yourself, but if you try to cover the short at a higher price, you may end up losing money altogether. 2. Unlimited potential losses, limited gains. When an investor buys a stock, the greatest risk there is losing everything he has initially invested in the stock, such as when the stock becomes of zero value. When an investor shorts a stock, the potential loss is far greater. Look at this. Suppose an investor shorts a stock at $20 a share. He can make $20 at the most in the transaction if the price of the stock goes down to zero. However, what if the value of the stock rises to $100 or higher? It's obvious that he would have lost at least $80 in the transaction. And who can tell how much more the price could rise? This is why it is imperative that you carefully study and market and monitor your short positions before you decide. 3. Interest rate changes impact. Most investors borrow money to short a stock, and if the interest rate on these borrowings unexpectedly and significantly goes up, the investor may end up with an overall loss. Factors such as the availability of shares drive rates to change daily. It's even possible for the rate to change from morning to closing time. So, any increase in the interest rate will ultimately affect the profit or loss of an investor's short sale transaction. 4. Buy in. There is a possibility that the lender of the stock may decide to pull back the shares that you are borrowing, making the shares unavailable to you. Of course, any good broker will try to get additional shares on your behalf, but if there are no more available shares, you could be in trouble. Experts call this scenario a buy-in. When this happens to you, the only recourse might be to buy stocks from the open market to cover your short. If the stock's value has risen by the time you purchase in the market since the time you originally shorted it, that will automatically be a trading loss. 5. Trade transaction errors. This is how a short normally works. When you execute the trade, your broker will already be sourcing for the applicable shares. If and when he finds them, that means you will not have the physical stock that you can deliver for settlement and you can execute the trade. The settlement will happen 2 trading days after your trade takes place, but a lot of things can happen. One is that the earmarked stocks may no longer be available. If you're left holding an empty bag, you would have to buy in the open market to cover your trade. Needless to say, it's going to cost you a bit more. 6. Margin call. If you're going to do a short sale, you need to have a margin account with a broker, and that means you have to abide by the rules of your margin agreement. One of the rules require that you maintain the minimum maintenance margin. Otherwise, they will send you a margin call to bring your account's value up to the limit. Most brokers require just a 35% margin, but some brokers will raise it to 70% if the stocks involved are too volatile. Market fluctuations may reduce the value of your account and may necessitate the sending of a margin call. A margin call will require you to add more funds to your account. If you fail to provide more funds, the broker may do some remedial measures according to your agreement. He could sell securities in your account or do a buy-in without consulting you, even if it could cause you to lose money. On the bottom line, and contrary to what many experts are saying, short selling is not all that bad. Similar to options trading and other advanced financial tools, it can be a very useful scheme for individuals who know how to use it to their advantage. Shorting can give you an opportunity to earn a profit when the stock prices are falling. Every investor should equip himself with sufficient know-how about short selling so he can opt to use it when appropriate. Short selling is an active trading strategy that comes with its own set of risks. Do not go into it without preparing yourself for the possibility of losses and without having a concrete exit plan. Determine ahead what you will do in case things don't go according to your expectations. As any other trade, you must also set a profit target for yourself. The rule is that you can make, at most, a 100% profit in an unleveraged sale, although that is extremely rare. Decide what is a reasonable return for you and close out your trade once you see you're on target or very close to it. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. Have an experience with short selling? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial educative videos.